Okay, so you think PayPal is just a way to pay for things online. Click a button, money moves, order confirmed. Simple. Safe. Slightly more convenient than typing your card number into a form. That's the whole thing, right? Not even close. Right now, while you're watching this, thousands of PayPal transactions are executing every single second across global computer networks. Millions of people are buying things on websites they've never visited before, and not one of them is entering their real banking credentials on those sites. The money moves. The merchants get paid. The buyers never think twice about it. And PayPal, the company sitting in the middle of all of this, doesn't manufacture anything, doesn't own a single bank branch, doesn't print money, doesn't have a product you can hold in your hands. In FY 2025, PayPal processed $1.79 trillion in total payment volume across approximately 25.4 billion transactions and generated $33.2 billion in annual net revenues. So, how did a company that started as an email money transfer app in the late 1990s become one of the largest financial infrastructure businesses on the planet? And how does it keep generating billions without selling a single physical thing? That's what we're going to break down. The revenue mechanics, the network effects, the fraud economics, the international margins, and why PayPal's greatest product was never money itself. Let's get into it. To understand why PayPal exists, you have to put yourself back in the late 1990s internet. The World Wide Web was commercially expanding at extraordinary speed. But there was a fundamental problem nobody had solved. There was no safe, native way to pay for things online. If you wanted to buy something from an online merchant, you typed your 16-digit credit card number directly into their website. That website could be legitimate. It could also be a server running in someone's basement with zero security standards. Fraud was rampant. Card testing was rampant. Encryption standards were inconsistent. And for most consumers, entering their primary banking credentials on an unverified storefront felt like handing your wallet to a stranger on a street corner and hoping they gave it back. The merchant side was equally broken. Traditional banks had strict underwriting requirements for merchant accounts. You needed operational history, physical collateral, and a compliance track record, which meant that independent sellers, sole proprietors, and early auction merchants, exactly the people driving the early e-commerce boom, had no reliable way to accept card payments at all. And international, cross-border transfers depended on paper bank drafts, money orders, or wire transfers taking weeks to clear. The infrastructure wasn't built for the speed commerce was starting to move. Confinity, founded in 1998 by Max Levchin, Peter Thiel, and Luke Nozek, and later merged with Elon Musk's X.com to form what became PayPal, didn't set out to build a bank. They set out to solve one specific painful problem. How do you move money between strangers on the internet without either party getting burned? The answer was a centralized software layer, a trusted intermediary sitting between buyers and sellers, absorbing the counterparty risk so neither side had to expose themselves to the other. The company wasn't trying to become a financial empire. It simply solved one painful problem. And that, as it turns out, is usually how the biggest financial empires get built. Understanding PayPal's early growth requires understanding a simple psychological problem. People didn't want to give their credit card information to every website on the internet. PayPal solved this by introducing what's called a proxy architecture, a structure that completely changed who sees what during a transaction. Here's how it works. The customer submits payment directly to PayPal inside a secure, centralized environment. PayPal authenticates the buyer, checks the available balance or credit line, processes the transaction on its internal ledger. The merchant receives confirmation that funds are cleared, along with the necessary shipping details, and fulfills the order. What the merchant never sees: the buyer's bank account number, card number, or any underlying financial credentials. This structure delivered four things that online commerce desperately needed at the time. First, financial privacy. Your real banking information never touched the merchant's server. Second, buyer protection. PayPal guaranteed full refunds on eligible purchases if items weren't delivered or were significantly different from their description. The platform absorbed the counterparty risk that had previously fallen entirely on the buyer. Third, faster checkout. By storing payment credentials centrally, PayPal eliminated the need to manually enter billing and shipping details on every site you visited. Fourth, fraud reduction. PayPal's automated risk algorithms verified buyer authenticity before routing transactions across card networks. Absorbing the fraud exposure that previously landed on merchants and consumers alike, the result was something the early internet urgently needed: trust. Not a feeling of trust, an economically structured system that made trust rational. PayPal functioned not just as a transactional utility, but as an insurer of online commerce. That insurance product, priced into every merchant fee, became the foundation of an entire business model. Technology alone doesn't build a global platform. Distribution does. And in the late 1990s, PayPal's approach to distribution was so aggressive and so effective that it's still studied in business schools today. PayPal paid people to join. Every newly registered user received $10 deposited directly into their PayPal account. Every person who referred them received another $10. This wasn't a marketing promotion. This was direct cash, sitting in a functional wallet, ready to spend or transfer. Three things made this strategy structurally brilliant. First, it rewarded both sides. By incentivizing both the referrer and the new user, PayPal maximized conversion. You weren't making a commercial pitch to your contacts. You were handing them cash. That's a very different social dynamic. Second, the reward drove immediate behavior. Because the money was deposited directly into a PayPal account, new users had an immediate reason to actually use the platform, either to transfer that balance somewhere or to spend it on a purchase. The incentive and the onboarding were the same event. Third, it embedded itself inside email. Every time someone received a PayPal money transfer notification, the email contained a link to create an account and claim the funds. The product literally spread itself through the communication channel people were already using. The result was a viral coefficient greater than 1, meaning each cohort of active users brought in a larger subsequent cohort. PayPal was adding users faster than it was losing them, purely through peer-to-peer distribution, and once the user base hit a certain density, something more powerful than the cash incentive kicked in. Network effects. More consumers holding PayPal balances meant merchants faced growing pressure to accept it. Refusing meant abandoning a rising share of potential buyers. And as more merchants integrated PayPal, more consumers preferred it because it worked everywhere they shopped. The acquisition effect brought people in cheaply. The engagement effect kept them. The economic effect, higher network density improving fraud models, made the system progressively more defensible. Viral referrals built PayPal's initial user base. But the real operational breakthrough came through eBay. By the late 1990s, eBay's peer-to-peer auction marketplace was expanding rapidly. But its payment infrastructure was a genuine problem. Most auctions settled offline, winning bidders mailed paper checks or money orders to sellers, who then waited 7 to 10 days for those to clear before shipping a single item. The whole system was slow, friction-filled, and structurally incompatible with the speed of e-commerce. PayPal saw the opening and moved fast. Developers built tools that allowed eBay sellers to paste custom HTML code directly into their auction listings, rendering an interactive Pay with PayPal button that let winning bidders settle auctions immediately. Using either a card or their wallet balance, eBay recognized the threat and launched its own payment product, a joint venture called BillPoint. But BillPoint required sellers to complete complex manual setup steps for every listing. PayPal's automated integration was faster, simpler, and spread through the seller community almost organically. When eBay tried to restrict PayPal's access to its platform, PayPal's seller community fought back. Power sellers who depended on instant payment clearing to turn over inventory quickly and reduce buyer drop-off campaigned publicly to preserve PayPal access. By 2002, approximately 70% of all eBay auction listings accepted PayPal. Around 25% of all closed auction purchases settled through the platform. eBay's response was to spend $1.5 billion acquiring PayPal in October of that year. Recognizing that payment processing had become essential infrastructure for its entire marketplace, the acquisition gave PayPal something priceless. A captive, high-volume transaction engine running billions in quarterly payment flow. It accelerated network liquidity, deepened data scale for fraud modeling, and locked in PayPal's leadership in online payments. That button looks like a single action. It isn't. It's the beginning of an automated sequence that runs across payment gateways, risk engines, card association networks, and banking clearinghouses, all within a few seconds. Here's what actually happens. The customer selects PayPal at checkout. The payment gateway encrypts the session and routes the transaction request to PayPal's processing servers. Within milliseconds, PayPal's risk engine runs an identity and fraud check, evaluating IP address reputation, geographic location, device fingerprinting, and the account's transaction velocity. Then it hits a fork in the road based on how the transaction is funded. If the customer is paying from an internal PayPal balance or a linked bank account, the transaction processes directly on PayPal's internal ledger. No card network involved, no interchange fee. Higher margins for PayPal. If the customer is paying by credit or debit card, PayPal generates an authorization request and sends it to its merchant acquiring bank, which routes it across the card networks. Visa, MasterCard, to the card issuing bank. The issuing bank checks available funds, verifies billing address and security codes, and returns an approval or decline code. Once approved, PayPal credits the merchant's account in real time and sends a payment confirmation, allowing the order to move to fulfillment. The actual cash movement, from the issuing bank through the card networks into PayPal's acquiring accounts, clears during nightly batch settlement cycles. Every participant extracts a piece of the transaction value. The card networks charge assessment fees. The issuing bank retains interchange, typically between 1.5 and 2.5%. The acquiring bank takes a margin, and PayPal captures its merchant discount rate on top of all of it. That layered extraction is where the billions begin. If you're finding this breakdown valuable, and we're just getting to the money, go ahead and subscribe and hit the like button. It helps more people find this kind of content. PayPal's FY 2025 net revenues came in at $33.2 billion. That money comes from several distinct income streams, and most consumers have no idea they're funding almost none of it directly. The core engine is the merchant transaction fee. When you buy something online using PayPal, the seller pays, not you. The standard commercial fee for PayPal-branded checkout is 3.49% plus 49 cents per transaction. For pay later options, it climbs to 4.99% plus 49 cents. Advanced integrations through Braintree drop slightly to 2.89% plus 29 cents. In-person QR code transactions above $10 run at 2.29% plus 9 cents. These percentages seem small. Multiply them across $1.79 trillion in annual payment volume, and they generate tens of billions in gross revenue. Cross-border transactions are where the margins get genuinely interesting. When a buyer's card originates outside the merchant's home country, PayPal adds an automatic 1.5% international surcharge on top of the base processing fee. When currency conversion is involved, PayPal applies a retail exchange rate with a markup of 3 to 4% above interbank rates. Stack those layers on a single $1,000 cross-border transaction, and PayPal's effective take rate approaches 9%. Then there's the float. PayPal holds the balances of hundreds of millions of users, funds sitting between deposits, withdrawals, and settlements. As of mid-2026, those balances totaled $39.74 billion. That money earns interest. PayPal invests it in high-grade short-term instruments, generating substantial income on funds it doesn't technically own. Add in Venmo monetization, buy now, pay later origination fees, merchant credit advances, and the 1.5% surcharge on instant transfers to external bank accounts. And the revenue architecture starts to look less like a payment company and more like a diversified financial services platform that happens to have a very recognizable checkout button. To an accountant looking at a line item, a merchant processing fee of 3.49% plus 49 cents looks like a direct operating cost. And it is. So why do millions of merchants keep paying it without negotiating their way to alternatives? Because PayPal doesn't function as a cost center for most merchants. It functions as a revenue driver. Start with the abandonment problem. Over 70% of online shopping carts are abandoned before checkout is complete. The primary causes are compulsory account registration, lengthy form entry, and buyer anxiety about entering card details on an unfamiliar site. PayPal's single-click login flow auto-populates stored billing and shipping details. The buyer sees a familiar interface they already trust. The friction that caused abandonment disappears. Merchants who integrate PayPal checkout typically see measurable increases in checkout completion rates. If a merchant operating at 40% gross margins adds PayPal and achieves a 10% lift in conversions, the additional gross profit substantially exceeds the processing fee cost. PayPal becomes a net profit contributor. Then there's the fraud transfer. Under standard processing agreements, merchants absorb chargebacks and card-not-present fraud losses directly. PayPal's seller protection programs absorb that risk for qualifying orders, shielding merchants from inventory loss and dispute penalties. So merchants pay the fee, because not paying it costs them more in abandoned carts and absorbed fraud than the fee itself. Trust, when monetized at scale, creates an extraordinary economic structure. Here's how PayPal's trust flywheel works. PayPal invests capital in risk infrastructure, artificial intelligence, compliance systems, fraud scoring algorithms, buyer and seller protection programs. That investment reduces counterparty friction. Lower friction drives higher checkout completion rates, increasing total payment volume. Higher volume generates richer data for fraud models. Better models lower the marginal cost of fraud per transaction, expanding operating margins. Wider margins fund further platform development. And the cycle repeats. Each rotation compounds the previous one. Fraud models trained on 25 billion annual transactions are meaningfully better than models trained on 1 billion. The trust product becomes more valuable as the network grows, which attracts more users, which makes the trust product more valuable. This is why PayPal can command premium take rates, even as competitors offer lower headline prices. A cheaper processing fee without equivalent fraud protection isn't actually cheaper for merchants. The total cost of accepting payments, absorbed chargebacks, dispute fees, conversion losses, favors the platform with the best trust infrastructure. Trust is a durable economic moat. PayPal spent over 2 decades building one. Processing 25 billion transactions a year requires risk assessment operating at millisecond speeds. Any meaningful fraud failure rate at that volume translates directly into hundreds of millions of dollars in losses. PayPal's fraud prevention architecture runs on a multi-layered automated risk engine that evaluates thousands of data points per transaction before any human being ever sees a flag. Defectu fingerprinting captures hardware identifiers, browser configurations, and IP subnet reputations to detect spoof devices. Behavioral biometrics analyze mouse movement, tap pressure, and typing cadence to distinguish human buyers from automated scripts. Network graph analytics map connections across accounts, shipping addresses, and merchant profiles to expose coordinated fraud rings. Real-time velocity monitoring tracks sudden shifts in transaction frequency or geography to catch account takeovers before they complete. The financial stakes of getting this right are enormous. Reducing global fraud losses by just 1 basis point, 0.01%, across PayPal's $1.79 trillion in annual payment volume yields $179 million in pre-tax operating savings. The advantage compounds. More transactions generate richer training data. Better models produce fewer false positives. Rejected legitimate buyers represent lost revenue too. The more PayPal processes, the better it gets at separating real buyers from bad actors. Fraud prevention isn't just a compliance function. It's a competitive advantage built into the core economics. Cross-border commerce is where PayPal's fee architecture truly reveals its design. In FY 2024, approximately 37% of PayPal's total payment volume came from international transactions spanning cross-border corridors. That segment is among the most profitable in the entire business, not because the transaction volumes are larger, but because of how the fee layers stack. Start with the domestic base rate, 3.49% plus 49 cents on standard branded checkout. Add the international commercial surcharge, an automatic 1.5% for transactions where the buyer's payment instrument originates outside the seller's home country. Add the foreign exchange conversion spread. When currency conversion is required, PayPal processes the exchange using an internal retail rate that includes a 3 to 4% markup above interbank rates on a single $1,000 cross-border purchase, a US. Consumer buying from a UK merchant settling in British pounds. The fee stack looks like this. Base commercial fee, $35.39. International surcharge, $15. FX conversion markup at 4%, $40. Total revenue captured by PayPal, approximately $90.39. An effective take rate approaching 9% on a single transaction. For context, that's roughly 2 to 3 times what the same transaction generates domestically. Meanwhile, the infrastructure required to execute the international payment, PayPal's internal ledger settlement, is marginally more expensive than domestic processing. The cost structure doesn't double with the geography. The margin does. Traditional banking rails struggle with cross-border friction, correspondent banking delays, and compliance overhead. PayPal's internal ledger executes multi-currency settlements instantly and captures the spread in the process. International commerce didn't just expand PayPal's market, it deepened its margins on every dollar that crossed a border. PayPal began as a desktop checkout button. That's not what it is today. As mobile commerce expanded, and as consumer behavior shifted toward smartphones as the primary purchasing device, the payment industry's center of gravity moved with it. Modern consumers expect single-tap checkouts, biometric authentication, stored card tokenization, and flexible credit options within unified mobile interfaces. The password entry form on a laptop is increasingly being replaced by a fingerprint on a phone. PayPal's response was to expand from a payment gateway into a multi-brand digital wallet platform. Biometric authentication was integrated into checkout flows, eliminating password re-entry. Venmo was monetized through debit card issuance and expanded merchant acceptance. Pay with Venmo monthly active accounts grew approximately 30% year over year in 2026. Buy Now Pay Later was embedded directly into checkout, driving over $33 billion in annual BNPL volume. Strategic acquisitions, Honey, Paydi, Zettle, and Xoom extended the platform into savings, installments, point of sale, and international transfers. The architecture underneath all of this is the same one PayPal was built on. Centralized trust management, counterparty risk abstraction, a network that becomes more valuable the more people use it. What changed is the interface. The business model didn't need to. PayPal doesn't have one competitor. It has several, each attacking a different slice of its business from a different angle. Stripe focuses on developer tools and digitally native businesses. Its API flexibility is genuinely superior for custom integrations, but it lacks a captive consumer wallet. It doesn't own the consumer relationship the way PayPal does. Adyen targets enterprise global merchants with direct clearinghouse access and transparent pricing. Strong for large retailers, but minimal presence in small business and consumer wallet segments, Apple Pay and Google Pay compete for native mobile checkout. Biometric verification reduces friction significantly, but both rely on underlying card network rails. They sit on top of existing infrastructure rather than owning their own clearing ledger. Breex Cash App competes for consumer peer-to-peer engagement and Gen Z accounts with strong banking and digital asset features. But a smaller international merchant footprint, traditional banks control credit issuance and deposit accounts, but consistently struggle to match the software iteration speed of fintech platforms. Each competitor is strong in its lane, but none of them simultaneously controls a consumer wallet, a merchant processing network, a peer-to-peer platform, an international transfer service, a BNPL product, and stablecoin infrastructure. That combination, assembled over 25 years, is what makes PayPal's position difficult to replicate quickly. No company processing $1.79 trillion annually gets to operate without serious structural pressures. PayPal has real challenges, and some of them are built into the same dynamics that made it successful. The biggest immediate threat is margin compression in its processing segment. PayPal's unbranded processing business, running through Braintree as a white label card infrastructure for large merchants, has been growing at mid-teens annual rates. But white label processing is a thin margin business. You're competing on price against other infrastructure providers, not on the trust premium that PayPal's branded checkout commands. Meanwhile, PayPal's high-margin branded checkout segment, the button with the PayPal logo, the consumer wallet login, the full trust product, grew only 2% in Q2 2026. The faster the unbranded segment grows relative to branded, the more PayPal's aggregate transaction margin percentage compresses. The revenue grows, the margin percentage shrinks. That's a harder story to tell investors. At the top of the funnel, Apple Pay's integration into iPhone hardware and browser-based tokenized card storage are narrowing the friction advantage PayPal's checkout once uniquely held. When your phone authenticates a payment with your face, a separate login becomes less compelling. Regulatory complexity is expanding. Operating across more than 200 markets means navigating fragmented privacy directives, anti-money laundering mandates, and money transfer licensing across dozens of jurisdictions. PayPal's PYUSD stablecoin has attracted direct scrutiny from the US Securities and Exchange Commission, and cybersecurity threats grow more sophisticated every year. Maintaining growth at this scale while investing in fraud infrastructure, product development, and international expansion is genuinely hard. The economics that built the platform don't automatically sustain it. The payment infrastructure underneath global commerce is being rebuilt in real time. PayPal is positioned inside several of those changes, and exposed to disruption by others, PayPal launched its native US dollar-backed stablecoin, PYUSD, issued on public blockchain networks. The goal is to streamline cross-border corporate payments by settling international transactions on blockchain rails that bypass traditional correspondent banking networks, reducing transfer fees and enabling near-instant clearing. If stablecoin settlement becomes mainstream in commercial payments, PayPal's early presence in that infrastructure could extend its margin advantage on cross-border transactions. Real-time payment networks like FedNow and Pix are introducing continuous clearing infrastructure. Open banking regulations in Europe are enabling direct account-to-account transfers that bypass card networks entirely. Both reduce transaction friction, good for commerce broadly, but they also erode the structural barriers that make PayPal's network valuable. The most speculative shift is autonomous AI commerce. As software agents begin executing purchases on behalf of consumers, the checkout experience moves from a consumer interface to a machine-to-machine API call. Payment platforms that build authorization protocols for AI agents operating within pre-approved parameters will capture that volume. Those that don't will find their checkout button bypassed entirely. PayPal's 25-year head start in trust infrastructure, fraud modeling, and global merchant relationships gives it a genuine foundation here. Whether it moves fast enough is a different question. Step back and look at the full arc. PayPal addressed a fundamental problem with the early internet. Strangers couldn't safely exchange value online. By building a centralized trust layer that absorbed the counterparty risk neither buyers nor sellers could manage alone. That trust product attracted consumers. Consumer adoption obligated merchants to integrate. Merchant integration attracted more consumers. The network fed itself, viral referral mechanics lowered acquisition costs to near zero. The eBay integration handed PayPal a captive transaction engine running billions in quarterly volume. The fee architecture, percentage-based merchant rates, cross-border surcharges, FX conversion markups, interest income on customer balances, converted that volume into billions in annual net revenues. Each additional dollar funded better fraud infrastructure. Better fraud infrastructure reduced the cost of trust. Lower costs widened margins. Wider margins funded further investment. The cycle accelerated. In FY 2025, PayPal processed $1.79 trillion across 439 million active accounts, generating $33.2 billion in net revenues and approximately $6.4 billion in adjusted free cash flow. The difference between a great year and a difficult one can be measured in hundreds of basis points, which translate to hundreds of millions in operating income. The business model works. The risks are real. The competition is intensifying. And the payment infrastructure beneath global commerce is being restructured by forces, stablecoins, open banking, AI agents, that didn't exist when PayPal was built. But here's what doesn't change. Before the final thought, if you want to go deeper on how businesses like this actually work, I've put together a comprehensive business guide that breaks down the frameworks behind great companies. You'll find the link in the description and pinned in the first comment. Well worth checking out. PayPal's greatest product was never money itself. It was making strangers comfortable sending money across the internet. Once people trusted the system, the economics almost built themselves. And understanding that dynamic, how trust becomes infrastructure, how infrastructure becomes a network, how a network becomes a financial machine, is the single most important insight you can take from studying how PayPal was built. If you found this video valuable, please hit the like button and subscribe if you haven't already. It genuinely helps this channel reach more people who want to understand how the world's biggest businesses actually work. Thanks for watching.